So this presentation is going to consider the issues that the financial world is currently worried about, and in particular what this means for the mining industry. In fact, the main issue that we need to consider at the beginning of this presentation and through the first half of my presentation is the availability of finance, and whether in fact capital is really more important, and the ability to raise finance is even more difficult for a miner at the moment than finding the reserves and resources in the ground. At the end of my presentation, I'll move on to looking at a case study in iron ore. This is particularly interesting because of the investment profiles in some of the parts of the world where in fact you might not be thinking that mining finance is going, but where they're offering potential for mining finance to be spent. So what are investors looking for when they're looking at places to put their money? There's a long list of areas that they might consider through the US, looking at the emergence of China or the continued growth of China and other emerging markets, through to general fiscal policy and risks in the market. And if we try and rank these to consider how they influence where finance ends up, we can see that some of them are neutral in terms of whether or not finance will arrive in the mining sector. But the three green ones show us that there is potential in the mining sector to attract investment. And this is particularly due to the continuing growth in consumption rates and in absolute consumption. Because even if we talk about a slowdown in China, the absolute level of growth and the total tonnages consumed are still growing at very, very large numbers, absolute numbers, which are interesting for new investors in the market. In terms of red indicators that might prevent financiers putting their money into the mining sector, we're looking at whether or not it provides a shelter from inflation and whether or not issues with the US dollar allow the mining sector to continue to be profitable as most of the metals are priced in dollars. I think overall we can conclude from this that there is demand for new projects, that the growth in the global markets is still supporting investments and exploration within the metals and mining sector. But investors do have increasing choice about where they put their money, and the case has to be made about whether or not mining is the place that they can get the reward for risk profile that they're looking for. Within CRU, we analyse a large number of commodities and the markets for those commodities, and we prepare this chart on a regular basis. This is where we look at the prospects for prices of different commodities over this year, and the following slide will look slightly longer. And at the moment, we're looking at a fairly tight trading band in terms of the prices of the commodities we consider. None of them are suffering from extreme highs or extreme lows at the present time, which in many ways is a good thing. However, looking in the slightly longer term, and this is looking at the price change from now to 2017, we're looking at significant falls in prices, particularly in iron ore, silver, potash, copper, sulfur, and gains in some of the LME traded, other LME traded metals, nickel, zinc, tin, etc. So over the longer period, 13 out of 22 commodities will be experiencing price gains. But coming back to the question of finance, where are companies going to get their finance from? And at the moment, we do have both people with money, and as I mentioned before, the financiers who now have a choice, or an increasing choice, about where they put that money. An English saying, once bitten, twice shy, means that once you've been bitten by an industry, you're unlikely to come back. And I think we could argue that at the moment they've come back twice and probably been bitten twice in the market. And perhaps ABM, which we say anything but mining, might be the choice that many of the financiers are considering at the moment. And we can in fact see this if we look at the numbers. If we look at the number of listings related to mining over the last 6 years, we can see that in the last year, the actual number of listings has fallen quite dramatically. You can see the venture market, Toronto venture market, has dropped out completely. and also in terms of the total equity raised within the market, significant falls have been seen. And this just suggests that the challenge is with the mining sector to attract that money back into the market. So, as I was mentioning, the investors have choices. I think you can't see my lines. The point of this chart was really to show that the equity classes and gold are diverging, and that at the moment, while there is some money, financiers are willing to move their money from the safe haven of gold back into equities and investments in companies like mining. And we're seeing a divergence in the two streams, which does show us that there is an appetite for slightly more risky investments at the moment. So is this new? Is this the first time that we're having problems with raising finance in the mining sector? Well, no. If you type scarcity of mining capital into Google, a news story from 1928 appears when there were exceptional conditions in Australia and heavy falls, and in fact people were still hopeful of obtaining success in raising finance before particular deadlines. So we can see that the story we have at the moment is in no way a new story for the industry we are in. So if we look at which kind of companies perhaps might be interesting, exploration is the R&D that sits behind the industry. It fuels the future. If we look at the three of the main exchanges, we're seeing a large number of companies, 600 on the TSX, 45 of the ones on AIM, who have very, very little working capital available to them, who are really struggling to have the resources to be able to continue with their operations. And if we look at maybe an interesting lesson from Darwin, where he says that it's not necessarily the strongest who survive, but in fact it is those who are most able to change and to adapt who are able to survive. And an argument would be that these junior exploration companies should truly be the companies who are able to adapt and should be able to change to be able to make them able to raise the type of finance that is needed. Again, it says that it's the weakest to adapt the fastest. This incentive of low finance is potentially what they need to make them move forward. So the question is, are the single asset companies the place where people should be putting their money at the moment? Is it the best use of an entire management team to manage a single investment in a single asset? Or should perhaps these exploration companies look to diversify in order to be able to adapt? Is it interesting for them to be larger, perhaps? Should they invest in projects that will come to market slightly sooner? There is a big risk coming from companies that invest in very early stage mining, where the material from that project will not touch the market for more than 10 years. That's a very long time horizon for people putting their money in. And also, the major mining companies at the moment are very reliant on these miners. They take advantage of the miners being able to raise expensive capital to do exploration and then buy them out. If these companies aren't going to exist, there has to be a new strategy within the majors to be able to raise the money to do this kind of work, and maybe they'll need to fund it themselves. At the moment, there's a strong focus on sorting through the types of projects that people are looking at. And the favour at the moment seems to be for the very small capital expenditure projects, which enable the money to be spent more broadly and to enable more people to continue. A quick look at what the majors are doing, and it's obvious from this chart that the majors are still able to raise money, that the problems of the junior miners has not transferred, and you can see that's 12-month data at the end, that the continued ability of the majors to raise debt through bond issues means that they are still in a strong position in terms of raising the finance they need. One issue, of course, is the many new bosses. If we look at the changes in CEOs within the major mining companies, I believe that 5 of the top 10 mining companies have had changes at the top since April this year. So The capital that's been raised by the industry, in summary, has been the lowest since 2008, reversing the trend of the last 2 years. Mergers and acquisition activity has fallen, and these CEOs have changed. But there is one source of light, and that is the money that's coming into the industry from the consumers. And if we look at my blank chart, is there anything on that chart, please? No, the one before. This one. No? Okay. This was some information that looked at the investment by consumers into the upstream sectors and pointed out that many consumers are now actually using their finance not to invest in their own downstream sectors, but to invest back upstream and lock in the supply that they need for their industries. So a case study for looking at this is iron ore. And it would be interesting to look at how the iron ore market is developing and perhaps what the prospects are for a company like Kazakhstan to grow exports of iron ore. So just looking at the history of the iron ore market, we're seeing that it's been highly volatile. This shows the margin at a selection of Chinese steel mills, but we are seeing margins improving over the last few months, and that as such, the sentiment among the Chinese steel mills has been improving. We've also seen an upturn in the amount of stock, so this is showing you inventory levels at ports. So those Chinese mills are not only making more profit, but they're also importing more ore, and that they're happy to increase their days of stocks. So where are those stocks coming from? Who are the people who are able to supply that industry? And if we look, the main change in imports has come from Australia. All three of the major iron ore mining companies in Australia, as you can see on the right, have significantly increased their exports into China and have taken up the challenge of meeting this increasing demand. In contrast, production in India has actually fallen, or total exports from India have fallen. And if we look at the ability or any future ability of India to meet demand from China, it really has to be in question whether or not they are a realistic source to meet future demand. The other possibility is Brazil, and we see, particularly for Vale, that production has been there's almost been no growth in production from Vale. So again, although there's been an upturn in the market, there's been no possibility of a reaction from them. So what's happened in prices with this inability of the market to supply all their needs? We've had a price spike, and in fact what we have at the moment is iron ore prices and coal prices very close to parity in the market in China. Why though did prices not go even higher when supply got so tight before the current demand? We think that crude steel production is currently higher than demand in China, so the underlying metrics within China are not necessarily as positive as is shown by the production of individual mills. Also, we've had restocking. The stocks have been reduced down to very low levels. And also, the higher raw material prices really began to put a squeeze on the EBITDA margins of the mills. And they were looking at lower price alternatives for their materials. And we have, in fact, seen over the last few months a reduction in the discounts for low-grade iron ores, which suggests that the mills are favouring low-cost iron units over productivity at the moment. And also, many people felt that the iron ore prices had just gone too high. Going forward, we expect the market to continue to be strong. It's going to be led by China, but we do see growth in most of the upcoming quarters, or on average over the coming years, which would support future iron ore consumption at the moment. The market fundamentals remain tight. Brazil and iron ore not keeping pace with the increase in demand, and Australia growing, but again limited by the capability of their infrastructure to allow for the exports that are needed. But they are trying very hard. Beyond 2013, we see prices in iron ore weakening. We see that the market will move increasingly into to surplus with global steel production easing. Growth in iron ore demand will slow. The raft of small miners who would perhaps have come into the market, or small consumers knock back many of the juniors who would have come into the market. But there are continued expansion plans. The West African juniors are particularly interested, and I'm going to come back to those, and they have particularly aggressive plans for marketing their material to make up some of the shortfall in the market. The question then is, how will China react? They have some of their own iron ore, and will they continue to import, or will they look at expanding domestic production? At the moment on the left we show Chinese production of iron ore. It's been indexed, but it shows that in real terms it is declining. We can also see on the chart on the right that the dots show historic and the squares show future, that over time Chinese production does follow spot prices, and as the spot prices come back down, so the production is likely to fall. There's a strong correlation there. And if we look at what's likely to happen to the cost curve, we see that the majors are continuing to produce low-cost iron ore, but that at the higher end of the cost curve, quite a change is going to happen. And the small private mines in China are likely to exit the market. The government-owned enterprises and large private mines are likely to decrease their costs, and if they can't decrease their costs, decrease their production. And there's a raft of higher cost emerging producers who will come in below the Chinese. So where else might it come from? If we look at projects, I've compared Kazakhstan, which is on the left, and West Africa on the right. If we look at the number of projects for iron ore that are in the market, we see that there's a huge number of feasibility projects sitting in West Africa, and the scale as well, 31 billion tonnes compared to somewhat less than 1 billion tonnes within Kazakhstan being explored at the moment. The grade in West Africa would also be slightly superior to the grade in Kazakhstan, and the shipping distance and the shipping cost, in particular, is very much less from West Africa to China than it is from Kazakhstan at the moment. We've talked a lot about the political situation in Kazakhstan today, and it's particularly interesting here to see the position of Kazakhstan in the fourth quartile. This is the Fraser Institute data, and the West African competitors, and see that in fact even the West Africans are sitting in slightly more favourable positions at the moment than Kazakhstan. And we can see that politics do influence investment, and that there is inward investment from both China and India into the West African market. They have been attracted, their capital has gone there. But if we look at who's investing in Kazakhstan, it's not those major consuming countries who are putting the money in. It's mostly local money. So in summary, we're seeing the juniors are exercising choice about which projects they're entering into and about how they go about entering into their projects. We're looking at exploration juniors probably being the survivors of the current low capital situation. We're looking at the majors who are hoping to reduce their costs, but who are also currently still able to raise the debt they need, and the continued need of China, Japan, and the other low-intensity countries to continue to drive demand. In iron ore, we see a good short-term picture, but in the longer term, the incumbents do hold all the cards, and the prices will fall, and the only place to be is a low-cost producer, a low-delivered cost producer. And at the moment, we believe Kazakhstan starts at a disadvantage, but I believe we've heard today about many of the measures that are being taken to improve the situation of Kazakhstan and encourage them to be able to participate in this market more efficiently. Thank you.